In the business world, methods in a number of entrepreneurial ventures, including as a partner in a $200 million fixed income arbitrage hedge fund. The professor's research at Columbia are in the area of optimization and control, stochastic systems, and decision-making under uncertainty, with an emphasis on financial engineering. He will discuss developments in the use of artificial intelligence and machine learning in the investment process and explain how quantitative investment managers work these days. He will discuss the current challenge, direction in which the industry is headed. So here is Professor Moallemi. Thank you.
Thank you, Anthony, for the kind introduction. I'm happy to be here today and speak to everyone. Before I dive into the material, wanted to do a couple of things. First of all, having given a number of these Zoom seminars up to this point, I find it works much better if, as I go along, people should feel free to ask questions. So in particular, if you have a question or comment or whatever, you can use the Zoom raise hands feature, and I will see you and I will unmute you, and feel free to ask. So it'd be nice to sort of keep this more like an informal conversation. So again, at any point, feel free to use the raise hands feature and interrupt me. The second thing I wanted to do before I start is just talk a little bit about what's going on at the school in light of everything involved with the COVID-19 situation. I thought you guys might appreciate a quick update from a faculty member. Obviously, situation has affected us as much as anywhere else. Certainly being in New York is one of the epicenters. Our greatest concern so far has been really for the students, to make sure that things have been going smoothly for them. And to that end, I think we really had a rapid transition from in-person events to virtual events in the second half of spring. So literally almost on a dime, all of our teaching switched to virtual. We've sort of really made an effort to support the students with various kinds of online events and networking events. So graduation was virtual and so on. And I really think we did a good job there. And given the circumstances, finished the year sort of quite strong. One source of concern for our students has been sort of the summer internships, and I think that's another place where the school has really tried to step up. A lot of companies have cut back on the summer internships, and that was an important aspect really of the educational experience for the students. And really we've tried to step up, and we have I think around 150 students who've been hired into sort of various research assistantship roles in the school. So basically the idea being helping various faculty with either their own research or helping in curriculum development, writing cases, and so on. So that's been a big effort amongst the faculty so far, and really the thing we're looking forward to now is the fall, and to some extent that's really a TBD situation. I mean, obviously there's a lot of uncertainty for us as there is for everyone else. What I will say is that the thing that I'm confident about is that we will be here. Now, exactly what the nature of that is really depends on health authorities and government regulations and so on. But really, what we're planning for at this point is something of a hybrid model where we simultaneously teach online, but have a reduced capacity in the classroom, perhaps rotating, in a sort of appropriate kind of a socially distanced way. So, I think there is a lot of uncertainty around exactly what the nature of that is. However, we do feel that the in-person experience, particularly in an MBA program, is quite important. And situation permitting, obviously, there are many things out of our control. The school is making a big effort to make that happen. Just wanted to sort of share some brief remarks on that. On that note, maybe I'll sort of switch over to the main topic here, which is an area near and dear to my heart, and that's the application and use of things like machine learning and artificial intelligence in quantitative investing. Anthony gave a nice intro. Just one thing I want to sort of mention is I'm very much come from a practical background. My training is really as an engineer. So I'm interested in mathematical models for things like quantitative investing, but I'm also interested in actually doing it. So in addition to my Columbia affiliations, I'm also a principal at a small quantitative proprietary trading firm. So I practice what I preach, or I drink my own Kool-Aid, and so on. So what my goal today is to sort of give you a perspective on how quantitative investing works, systematic investing, and also give you a sense of sort of what the current challenges are, how ideas such as machine learning and AI are percolating into the space, how investment managers are using them, and so on. So that's going to be the plan today. Just to sort of start off at a high level, one sort of big caveat is what I'm going to talk about today is a particular type of investment, and that's active investment. Right, the idea of active investment is you're buying and selling assets, be they stocks, bonds, whatever, because you have a view. Right, you're buying because you think the price is going to be higher later. You're selling because perhaps you think the price is going to be lower later, and you can buy it back cheaper. And what I'm going to be talking about here is applying quantitative methods to the active investing process. So that's quite different than some things you hear about that people also label sort of quantitative, which is things like factor investing or smart beta, so on. I'm not going to touch on those so much here because number one, it's not what I do. But number two, it's also not really where these type of methods like machine learning are relevant. I think they're much more important in the active in investing space. So before I sort of dive into the material, let me just give a little bit of background on quantitative investing overall. There's sort of the theory versus the practice. The standard sort of classical economic theory is that markets are efficient, right? And now, if markets are efficient, what does that mean? It means that the prices should incorporate all available information at any particular instant in time. And therefore, there should be no opportunities to apply methods like machine learning or so on to quote unquote predict future prices. What is there to predict, right? Because markets are efficient, right? Everything is already incorporated into the price. Now it's a little bit of a straw man, but that's the theory. What is the reality? It's not true. And I think the proof that it is not the case is sort of an existence proof, and it's the existence of people like Jim Simons and places like Renaissance Technology. So Jim Simons is an investment manager. He's a former mathematician, founder of a company called Renaissance Technologies that does quantitative trading. A very nice book came out about him earlier this year. In fact, we had the author on campus, and talks about how Simons is really one of the pioneers in quantitative investing. Sort of quit as a math professor in the 1980s and switched over to basically developing systematic automated computer models to trade, and he's been enormously successful. Right, so he's done quite well for himself. In addition, his flagship fund, the Renaissance Technologies Medallion Fund, has done quite well for their investors. So they have had an average 39% annual return, which is absolutely astronomical, over a 30-year trading horizon, and this is after fees. Right, so and you can imagine someone who's this successful is able to extract quite a large fee for that service. The returns before fees are something maybe close to 70% annualized year after year. And just to maybe put that into perspective, we can compare him with people maybe more of you have heard of, maybe people like George Soros or Warren Buffett or Ray Dalio of Bridgewater, and over sort of similar kinds of very long time horizons. Simon is perhaps the most successful of them all. Right, and it's just not a matter of applying quantitative methods to sort of get these very high returns. It's also actually he's developed strategies that scale. So the 39% annualized return has translated in over excess of $100 billion in trading profits. Right, so not only high return, but I'm doing it on quite a large kind of scale. Perhaps what's most impressive is that this $100 billion has been made with very little risk, in the sense that over 30 years, this investment fund has only had one down quarter, right? If you compare that to someone like, let's say, Warren Buffett may have made more money in an absolute sense, but there's years when Warren Buffett loses a lot of money. For example, this year he's down multiple billions, right? So it's kind of quite amazing to make this scale of money over this period of time with this low level of risk. By the way, if you're curious, how are they doing this year with all this craziness? They're up 24%. Right. So again, sort of going back to the straw man I set up, it's simply not true that markets are fully efficient. There are these sophisticated quantitative investors out there, people like Jim Simons. They apply sophisticated mathematical models, and they do quite well. Any questions? So, I mean, I think another trend we see sort of quite broadly is the rise of things like artificial intelligence, whatever that is, and machine learning. We see that these sort of technologies arising in broad areas of business, and the natural kind of a question to sort of think about is, how is that entering into this area of quantitative investing? So before I go to that, let me talk about some of the recent developments in AI and machine learning, some of their big successes broadly, and then we'll reflect on how that comes into the quant investing world. So let's talk a little bit about again, some of the big recent successes of AI. One of the biggest successes, and perhaps the thing that sort of launched this deep learning revolution, in maybe around 2012, 2013, is image recognition. Right, so basically looking at a picture like this and being able to say that this is a cat, and it's not, say, a water bottle or whatever else. State-of-the-art methods are these models called deep neural networks, which are schematic form look something like that, and in fact they work better in humans, and these types of things are used all the time at scale in all sorts of things that probably you use every day. Things like tagging people in photos or self-driving cars or so on. This has been one kind of sort of huge success. This was something that, again, like maybe 10 years ago, was sort of image recognition was quite hard, and the problem has largely been solved. At least certainly things like identifying this as a cat. But reflecting on this, thinking about this recognition problem, at some level, identifying this as a cat is an easy problem, right? I could do it, you could do it. You could train a baby or certainly a dog to identify this as a cat, right? There's a lot of information there. There's no ambiguity, right? So we didn't know how to get computers to do it, but at some level, at least for kind of humans, it wasn't a hard task, right? And phrased differently, this kind of high signal to noise ratio. If I show you a picture, namely this picture with a cat in it, it is obvious that there is a cat in that picture, and probably no one here would really argue with me or contest that. So while indeed there have been significant advances in developing image recognition, at some level, at least for humans and other animals, it wasn't a hard problem to begin with. Right, now let's contrast that to sort of financial markets. If we're, again, in this active investing world, if we're trading because we think future prices are going to be higher or going to be low, if we're trying to predict asset prices, this is extremely difficult, right? Not only for certainly for computers, but also for humans. Why is it difficult? Because it's competitive and you can make money doing it, right? If you identify some kind of inefficiency, something which gives you a little bit of insight into what the future price of the stock is going to be, or something like that, perhaps you'll have a model that works. But over time, other people are also, actively trying to do this, because again, if you can predict future stock prices, you can make money, right? And so this competition ends up in ultimately the predictions are very weak, right? There's yes, it's true that there are inefficiencies, and people like Jim Simons profit from them, but the inefficiencies are very small. If we look at what fraction of the overall movement of stocks can be explained through the models, it's extremely small. The predictions are very weak, and also over time the models stop working. Right. This is a phenomenon known as alpha decay, where you may put in a lot of effort, you may identify data, you may build a sophisticated a machine learning based model. You'll have a model that will work, will give you some sort of weak signal of is the stock price going up or going down. But what will happen is over time, year on year, it'll be less and less effective. And that's because, again, it's an extremely competitive world. There are other people out there, very smart people with lots of resources, and as they identify those things, they will disappear. And I think Lasse Pedersen, who's an academic and also a practitioner, has a very nice book where he describes this markets as being efficiently inefficient. Yes, there are inefficiencies, and again, that allows people like Jim Simons and Renaissance Technologies to do quite well. But it's really hard, and people sort of compete at it, and it's not something I would sort of recommend. If you're not a really an expert. And so contrasting that with what we had before we were thinking about this image recognition problem, which I argued was very high sort of a signal to noise. This is a very low signal to noise regime. Right. So this is, again, finding patterns in the stock market and asset prices. It's extremely difficult. It's not immediately clear if you have some, convolutional neural network that's great for problems which are in some sense obvious, like identifying cats. It's not clear that technology immediately ports over. Right. So that's one a big success, I think, in AI is image recognition. Again, not clear how it applies here. Another big success, games. Right. If you look at games like chess, shogi, Go, and so forth, all of these games at this point in time, state-of-the-art methods are deep neural networks trained with something called reinforcement learning. They are better than other methods that have been developed in the past, and they are way better than humans. And then this is something quite remarkable. Again, I mean, chess, computers sort of advanced ahead of humans maybe in the late 90s. Go, people thought it could be done for a long time, but it was again done I think about 5 years ago, and this is the AlphaZero Go player. This is a division, DeepMind of Google developed this, again, deep neural network-based player to play Go, and it's better than humans. And one, sort of quite remarkable thing about these deep neural networks and this idea of reinforcement learning is they built this Go player without any kind of knowledge of let's say Go, right? Except the rules of the game. What moves are allowed, what positions are allowed, or so on. In particular, no kind of sort of human knowledge about, well, this board configuration is good or this board configuration is bad. The idea of, deep neural networks and reinforcement learning is instead, let's use data. Let's use data and play many games, and let's let the computer figure out what board configurations are good versus bad. Let's not sort of pollute it with our own, kind of human prior knowledge. And again, that's very different, and that's been a big revolution, right? But if you sort of sit back and think about it a second, in order to really become a master of this this game of Go, and in order to develop these computer players that are again really state of the art, you basically need a lot of data. right? Again, you're substituting having lots of data and lots of compute instead of having sort of human intuition about how the game should be played. And if you have access to a lot of computers and a lot of data, that's great. And indeed, in games like chess and Go and so forth, you do. Why? Because you can have the computers play themselves. You can generate as much data as you want. Have some basic computer players play other computer players again to train better ones, and rinse and repeat and so on. There's essentially infinite data in this world. Right, you can again have as much data as you want, and these methods are very successful. On the other hand, let's think about applying some of these, shall we say, very data-hungry methods in the investing process. If you think about doing that, financial markets are quite different, right? Number one, financial markets are non-stationary. That simply means that the world is changing over time. Right, and the data from quite a long time ago may not be relevant, right? So if I don't know, let's say you're trading stocks in the United States, you really can't. It's not really relevant to look backwards more than 10 years, because the world was a different place. There were other investors around, and they had different goals and so on. And data from too long ago isn't relevant. So you're limited with to sort of really, I don't know, something like, let's say the past 10 years, right? You can't generate more data. You can't really go to other markets because they're different also. Right? You can't build necessarily predictive markets for, let's say, U.S. equities using Japanese equities, because there's different investors trading in Japan. The assets have sort of a different property. So again, quite limited data. And in fact, the problem gets worse as the further you go out, right? So if you're thinking about doing longer term trading, like let's say you're trading where you buy a stock and you hold it for a year, you basically have one observation per year. Right, and so now I argue you can only go 10 years back. That's basically 10 observations. You don't have a lot of data, right? So phrased differently, the financial markets world really, as much as we imagine that there's a lot of data in terms of all these electronic markets and these tick by tick data feeds and so on, you really cannot rely on data alone, because in fact there's not a lot of data, and you don't have the freedom to sort of generate as much data as you want the way you can by playing let's say playing Go and so on. So again, all I want to do is sort of highlight here some of the big successes, computer vision image recognition, computer players for chess and Go and so on, that you may have seen, and just argue that they operate in domains that are actually quite different than the domain that I'm concerned with, which is leveraging these things in the investment process, right? So what's really the reality of these types of methods in quantitative investing? The reality is this isn't anything new. This is a mature industry. People have been applying quantitative models to invest. Probably the earliest players were in the 1960s, but certainly since the 1980s, the most successful people like Renaissance Technologies, Two Sigma, Citadel they were the most successful people 10 years ago also. So they've been doing it, and people have applied state-of-the-art models, and very smart people again with a lot of resources. There is no reason to think that there's going to be a singularity and things are going to rapidly change because we have these neural networks or whatever. Yes, those are additional tools in the toolbox, but what I really expect to see is that instead of markets sort of really drastically changing, what we're going to see over time is we're going to see careful engineering that's going to apply many of these methods and lead to incremental improvements, right? And so what I'd like to do today is give you a little bit under the view under the hood and show you what some of these kind of issues are and some of the methods that people are applying. So that's my plan for today. Any questions? All right.
Yes. Can you hear?
Yes, Anthony.
Yes. Are you looking for something that simply isn't significantly there? Are we looking for repeating predictable patterns in a process where the patterns constantly change? and even a 10-year data set is too long?
Yeah, I mean, you are looking for things that constantly change. You know, when you build these models, you may have a model that you built today when you put a lot of effort in and works. And what you'll observe is, you know, as I mentioned, over time, they will stop working, right? So the firms that are successful at this are constantly developing new models and retiring the old ones that don't work. It's not that you have a successful investment strategy today and you just, you know, keep the computer powered on and hit the beach. No, I mean, you're sort of innovating in terms of developing new models. Now, as to the particular question of how far back should you look, and is that too far back, and so on, in general, there's a trade-off, right? Obviously, the further back you look, the more data you have, which is good, right? The flip side is the further back you look, the less relevant that was, right? So, you know, I think it a little bit depends on your horizon. People who are making predictions at very short horizons, like if you're really more of a high frequency trader, you're trading in and out very quickly, you may be able to get away with just very small quantities of data. Maybe you only look back a year, right? People with longer horizons, you know, maybe look back, you know, 10 years, right? If you start to look back more than 10 years, you know, the world was really different. For example, let's say 15 years ago, markets were largely not electronic, right? And it was just, you know, a completely different set of players. So, you know, sometimes you hear people bragging like, oh, I have the stock data series and it goes back to 1927 and, you know, so on. I think that's, you know, at least for the type of things I'm familiar with, that's like nonsense, right? I think 10 years is maybe an outer limit of what's, and if you can get away with less, that's better.
May I ask another question, which is,
sure.
Why is there because of competitive pressure that closes the knowledge gap, or is it because the whole process is more like turbulent water flow that just simply changes all the time and really isn't predictable?
I think it's more the former. I mean, probably both, but certainly the former is an enormous effect. I mean, I'll think about it. So suppose I were to discover one day that if it's sunny in New York, that it's more likely the market's going to go up, right? So maybe I have a whole data set. You know, I tried in Paris, I tried in Tokyo, you know, so on and so on, and that works. At some point in time, other people are going to figure that out. Right. And so, you know, once other people figure that out, there's a sunny day, boom, everybody buys, the price instantly adjusts. Right. So this competitive pressure, as other people identify the same inefficiencies that your model has identified, it makes those inefficiencies disappear. And so I think that's the dominant sort of evolutionary force, if you will, that makes things change over time. That makes sense.
Yeah. Thank you.
Thank you for the questions, by the way. All right, so let's take a look under the hood here. Want to make just sort of a couple of comments, things that might not be obvious to people who are not in this domain and who are more familiar with traditional investing. Again, we're in this very low signal to noise ratio regime. The effects you're trying to pick up, the inefficiencies, are very small. Again, because if there were big inefficiencies, someone else would notice them also, right? So, you know, a couple of implications of that. You know, again, you need lots of data, and a lot of data might not be there for the reasons that we're talking about. But sort of deeper implications in terms of the type of strategies that come out in the type of trading is that if your edge is very small, if you know, stocks may move, you know, up and down 5% a day, but your predictions are like 1/100%, something like this, what you want to do is you want to make really very many small independent bets. Right. So on any particular bet, you may win or you may lose. But if you can make many bets and they're independent, as you will no doubt remember from statistics class, we have the law of large numbers, and it'll average out, and you'll make money. And I think for those who are familiar with it, the right analogy is maybe card counting in blackjack, right? You know, so card counting is a methodology in blackjack where you actually have an edge over the house, and you can potentially make money, but your edge is very small. So on any particular hand, you still might lose, even though you have a 0.1% chance more of winning and losing. And the way to sort of get around that is to play many, many, many times. The quantitative trading game is the same. And again, in order to make these many independent bets and have the luck average out and to just be able to eke out that edge, what you want to do is you don't want to hold things for a long period of time, right? So quantitative trading, I think on the outside, your hold times are like on the order of a couple weeks or a month. Right. So, again, you're buying a stock because you think the price is going to go up or down, let's say over the next month, if not shorter. Right. Why is that? Well, if I'm making 1 year bets, if I'm making 5-year bets, I can't make a lot of bets. I can make more bets if they're a more shorter period. Right. Because simply, my total period of time can be divided into smaller subintervals. So I want to diversify, and making short bets, having short hold times is a way to diversify over time, right? And the implication of that is this type of thing works well in liquid assets, right? Because if I want to be trading in and out of something quite quickly, maybe on the time scale of a month, maybe even down the time scale of minutes, right? It should be liquid. So, we're thinking of things like stocks, like futures contracts, and so on. We're not thinking of things like, venture capital, where you sort of sign a check and you have to, wait 10 years to sort of figure out what happened, right? Similarly, you want to trade many things, many sort of independent things, and try to hedge. You want to, in other words, spatially diversify, maybe diversify over different securities, right? So, in the US, a quantitative trader might be trading 3,000 to 5,000 stocks at any given time. Again, having very small short-term positions in and out of each one of those stocks. Type of thing you do not want to do is you do not want to make systematic or factor bets, right? You do not want to bet that all technology stocks are going to go up, because even though that may result in you buying 20 technology stocks, it's all correlated. It's really just one bet. Right. So what you really want to do is you want to be betting some of those tech stocks are going up and some are going down, and you want to sort of hedge and bet on idiosyncratic movements, not really bet on factors like the technology sector or the oil sector or things like that moving. And this intuition is really the opposite of what you see in things like value investing, private equity, venture capital. The idea there is certainly if you talk to someone in venture capital, they do not feel that their edge is small. They feel that their edge is quite large. They're going to make 100x, right? Well, we're not going to make 100x on a trade. We're going to make 0.001%, right? And so venture capitalists might make a small number of large investments, whereas sort of a quant investor will make many, many small investments, and again move in and out. Certainly not holding things for years and so on. So it's a little bit of a different different kind of model. At a very high level. Yeah, Anthony, question.
Yeah. If your expected returns are very, very low and you're making lots of transactions, don't transaction costs become, a more significant drag on your returns?
Absolutely. So a big thing, which I will segue into a bit, is modeling transaction costs, right? So your returns are very small. And so if they're less than the transaction costs, obviously it doesn't make sense to put on that trade. So you have to ensure that they're more than transaction costs. Also, in general, these types of funds pay an enormous amount in transaction costs. Again, as opposed to, let's say, a value investor, like a guy like Warren Buffett, he'll go out and buy a bunch of airline stock or whatever, and he'll hold it for 2 years. Right, versus a quant firm may be, a holding for, again, days or weeks, cycling in and out, and so on. So, Warren Buffett doesn't really think about transaction costs, right? Mm-hmm. But transaction costs here are sort of a first order thing, and very important. And we'll get to that in a little bit more detail. So, at a very high level, we can divide the sort of quantitative investment process into sort of 3 things, and I'll touch on them each in sequence. The first thing you need to do is you need to make predictions. You need to predict returns, equivalently predict future prices, and so on. And again, you're trading because you have a view, right? You have a view of what's going to happen. It may be a very weak view, but nevertheless, it's a view, and that's going to come from a prediction. So those predictions, you're going to have predictions for, let's say 5,000 different stocks. Those are going to be fed into a portfolio construction process. And basically, the idea there is to sort of identify a portfolio which will sort of be advantageously positioned should those predictions come true. And so here you want to balance risk and return and so on. Once you you have your predictions, you've identified what is the portfolio that you want to hold. Execution is a big problem, right? And execution is basically, here's your current portfolio, here's where you want to be. How exactly do I do that? What trades do I send to the market, and so on? And again, in many of these markets that I'm talking about, certainly equities, futures, and so on, they're entirely electronic at this point, so that's another kind of automated process. And there's a little bit of feedback here in order to figure out what portfolio you want to hold. You have to think about your transaction costs, but your transactions costs come when you actually trade. So the portfolio construction process, it passes over a trade list, but in order to sort of construct that list of positions it wants to hold, it needs some feedback in terms of how much is it going to cost me to get into these various positions, so I can ensure that my predictions exceed that and I actually expect to make money. So I'm going to talk about each of these three aspects in turn. When you're thinking about return prediction, where do these models come from? Or there's a lot of different data. Tons of different data sources that you could use, right? So, here I've sort of listed a bunch. The classical ones are, things like these sort of top things where you use prices to predict prices, right? So let me give you a simple example of that. You might look at a particular asset, let's say a stock, and you might say over the near term, it's been going up. Maybe you think it's going to continue to go up. That's something called momentum, right? Or maybe you're looking at one stock, you're looking at Apple, and Apple has gone up. And there's another stock out there, let's say Google, and they're both large, sort of consumer-facing tech companies. If Apple stock goes up and maybe Google doesn't move, they're both exposed to a lot of the same underlying economic factors. Maybe there's a mispricing there, and maybe Google is about to go up, right? And so price of other stocks may be useful. So these top things are what are called technical data, basically using prices and trades to sort of look for patterns that predict other prices or trades. That's sort of what was kind of done classically. What we see now is really a shift to things called alternative data, right? As these traditional sources like prices are sort of mined clean and there's not a lot of predictability, people go and look at things like satellite images, right? There's companies out there, at least 3 I know of, whose sole purpose in life is to task imaging satellites to go around the world and let's say take pictures of Walmart parking lot at 12 noon in Chicago today and compare it to what that parking lot looked like a year ago, and to get some kind of guess as to what the floor traffic is in that Walmart store, and to use that to try and make a prediction of what Walmart stock is going to do. Right. Similarly, there's many third parties selling things like anonymized credit card data. There's people mining social media. People talking about stocks on Twitter and so forth. And the general trend has been moving to sort of these types of alternative data. The idea being that if you can identify a data source which has a predictive value and which other people don't have, then you can potentially leverage that and in order to come up with models that aren't arbed away and where you can make good predictions. So in general, there's a shift to sort of all these new alternative data sources. And when you hear about people sort of selling anonymized credit card data or anonymized location data from cell phones or so on and so forth, who's buying that? Quant hedge funds. They're the number one consumers of that type of data. There's also innovation on the modeling side. So here I have a whole bunch of different classes of machine learning algorithms, right? Historically, regression was the bread and butter, literally linear regression, ordinary least squares, just like you've seen in, if you again remember your statistics class. But over time, there's been a general shift to things that are more complicated, including things like deep learning and decision trees and random forests and so on and so forth. So in terms of return prediction, the industry has been evolving, by using new and different types of data, and also using new and different types of machine learning, and that's where a lot of these machine learning things have been coming in. But in my view, it's a little bit incremental. It's not like neural networks are all of a sudden something new and very different. There's something that you can do on top of doing regression and doing random forests and whatever other algorithms you are. And indeed, Renaissance is very secretive. They don't talk a lot about what they do. But one thing they have said is that they do a lot of linear regression. So, even simple stuff can work. If you have data that other people don't have that's valuable, maybe you just use linear regression. If you're reading data that's sort of widely available, then maybe you have to innovate a little bit more on the predictive front, and you have to use more sophisticated machine learning models. And the truth is, people do both. Again, but the predictions are very weak. As Anthony pointed out, you have a transaction costs, which are important. So the way we sort of think about exceeding transaction costs is we combine many different predictions, right? Maybe you have a model which uses price data and recurrent neural networks. That gives you one prediction, right? You have another model which uses satellite images and some computer vision. That gives you another type of prediction. You have some other thing which is analyzing news articles and using natural language processing. You may have tens, hundreds of even thousands of distinct models. You combine them into one kind of aggregate prediction. And when these different predictions are lined up, when they're all going in the same direction, even though each of them is individually weak, as you combine the outputs of those models, you start to exceed transaction costs. And now you're cooking with gas. You can actually put on a trade and expect to make money and exceed your transaction costs. So there's a lot of challenges there. Thinking about, okay, you have 100 or 1,000 different predictive models. How do you combine them to get one overall view? At the end of the day, you care, is the stock going up and I should buy it, or is it going down and I should sell it? Right? And so if you have all these different predictions and some of them are going different ways, how do you combine them? How do you manage correlation? Right? If I have two different predictors and they're highly correlated, right? They're both always going the same way. Sometimes, even though I may think they're two different predictions, they're really the same prediction, right? And so when you're developing models, when you're researching models to identify inefficiencies, what you want to do is identify models that have predictive power, number one, but number two, are also uncorrelated with the models that you already have. Right? Because if you finding signal that's correlated with what you already know is useless, right? And so those are some of the current challenges. Overfitting is also a very big issue. Shifting directions a little bit, portfolio construction. State-of-the-art method in portfolio construction for a long time was what's called single period optimization. This was I think one of the biggest successes of academic finance. Was developed by Harry Markowitz in the 50s, and he won a Nobel Prize for this. And the idea is here basically pick a time horizon, right? You're trying to figure out what portfolio you want to hold. Let's pick a time horizon. Let's say 1 month. We have a whole bunch of predictions for each of these. Let's say 5,000 different stocks, what they're going to do over the next month, right? We have a risk model for how they're correlated, and what we'll do is we'll try to construct a portfolio that maximizes how much we expect to return over what we expect the returns to be over the target horizon, subject for a penalty for risk. And the nice thing about this is it's very flexible, very scalable. You can do it with thousands of assets. You can add things like transaction costs or constraints. Maybe you want to limit how much you trade in any particular stock. You want to limit exposure to sectors and so on. The general Markowitz framework is extremely flexible, and the way you apply this is you replan periodically. Right, your predictions are always changing over time. So maybe you're making predictions going 1 month out. 15 minutes from now, your predictions will be slightly different. So 15 minutes from now, you kind of replan, and 15 minutes from them, you replan, and so on. But in any given time, you're kind of focused on one kind of a long-term time horizon and adjusting your portfolio in order to match that. So the challenge here is where did you get that time horizon? Right, and when I'm sort of trying to decide, should I buy or sell a security, right? There's sort of two things that are important when I think about what time horizon should I think about. One is the time horizon of my predictions, right? If I'm sort of if my predictions are my prediction is that the stock is going to go up in 5 minutes, then thinking what my portfolio is going to be in a month is not relevant, right? Similarly, if my prediction is very, very kind of long-term, if I'm making a 6-month prediction, right, then planning for the next 5 minutes isn't very, very relevant because the prediction is not going to be realized, right? Second thing is your predictions should actually line up with how long you end up holding the assets, right? So if I have again, I'm making predictions for 1 month and I apply this Markowitz procedure and I actually trade, right? It should be the case that I typically hold my assets for 1 month, right? But here we have a little bit of a chicken and an egg problem. I'm planning for things out a month. That's going to generate my trades. My trades are endogenous. Maybe I end up holding them for a month. Maybe I end up holding them less or more. And what makes this more complicated is that it's not clear that there's one time that is relevant for all securities, right? So again, for example, think that you're trading U.S. equities. On the one hand, you might have a stock like Apple. Apple is an extremely liquid stock. You can go in there in an instant of time, buy or sell millions of dollars of Apple stock, and you will not move the price. The costs are very low, right? On the other hand, if I go to stock number 1,000 in terms of liquidity, that's going to be a lot less liquid. If I'm trading these two stocks, which have different liquidity in a coherent fashion, I should be trading in and out of Apple very rapidly because it's inexpensive to, and this less liquid stock, whatever it might be, I should be holding for a longer period of time. Right, so this sort of single period Markowitz idea, it's sort of predicated on having one sort of a time horizon, but that doesn't make sense. It's not coherent if you think about it. And so the challenge there is really thinking about moving away from this idea of having one time horizon and thinking about having problems which are intrinsically multi-period, where I don't imagine what position I want to hold today to profit in a month. I think about what position I want to hold today, realizing that in 15 minutes I could change my mind. And that for some assets, I want to really trade in and out of them very quickly. But for other assets, because it costs more, I want to hold them longer, right? And in terms of thinking of my predictions, I don't want to just make one prediction of what's the stock price going to be in a month. I really want to predict a trajectory. I really want to think about what's the stock price going to be in a minute, what's it going to be in an hour, a day, a week, and then maybe a month, something like that, right? Because again, depending on what the particular asset is, different points in that horizon might be relevant. For things that are very liquid, I really care about making short-term predictions. For things that are less liquid, I care about the long-term predictions. So moving, I think the big sort of challenge here is moving from sort of a single period view to an inherently kind of multi-period view. Last thing I'll mention is that execution and trading costs, again, extremely important. If you have better estimates of trading costs, you can trade more aggressively because you are more confident about when your predictions exceed your trading costs. And so, having a good models for transaction costs basically lets you more effectively monetize your predictions. Now, the challenge here is that if you're a large institutional investor, your largest trading cost is not paying your broker or whatever, it's price impact. In other words, when you make a large trade to get into a position, you move the prices, right? And the reason why it's challenging is it's not directly observable. Nobody's going to tell you put on this trade and the price went up by a dollar, right? Instead, what you're going to see is you put on the trade and the price moved. Maybe in fact you bought and it went down, right? And that's because even if you're a large investor, your trades are not the sole determinant of prices. There's all sorts of other things going on. Other people are trading in and out. There's news that comes out and so on. In other words, there's noise, right? So you can put on a trade and see like maybe you start buying and maybe the price goes up. But how do you know that it was because of your trading that it went up and it just wasn't random, right? So that's one kind of challenge. Another kind of challenge is really identifying cause-effect relationships, especially versus confounding factors. For price impact, you really want to understand, I put on a trade and then the price went up, right? And the big confounding factor here, the big thing that muddies that is you put on the trade because you thought the price would go up, right? So maybe had you not even put on that trade, the price would go up because your model said it would go up and your models are accurate, right? So disambiguating, well, I was buying the stock and I saw the price go up, was it because my act of buying the stock and I generated that price movement? Or, for example, was it going to go up because my models were correct? That's extremely difficult. And this really comes down to understanding cause-effect relationships. And so, again, current type of directions are I'm really thinking about experimentation. right? The gold standard for understanding cause effect, like, when it's not, some stock trading, but it's really a matter of life and death. For example, when you're thinking about pharmaceutical trials, right? If, I'm going to take some Lipitor and I want to know, is it going to have a positive outcome? You do a randomized trial. Right, you do a randomized trial, and that will balance out confounding factors and noise and so on. And that's the direction right now in the quantitative investing world. To understand things like what are your trading costs, you need to do some experimentation. You need to know things like A/B testing or some randomized trading, because you know that the randomized trading has no confounding factors. So if I buy not because my bottle's shut, I should buy, but I buy because I flipped a coin and then the price moves up, I have much more confidence that that price movement was because I was buying. And indeed, again, this is a little bit anecdotal, but it's generally thought that the Renaissance has maybe the most advanced transaction cost models, and that allows them to trade more aggressively than other people. And that's one of the drivers of their tremendous outperformance. Question, Justin.
Yeah, I'm mainly intrigued by this A/B testing or randomized experimentation point. Is there a way that is there a tool that we can actually do that without investing capital? Is there like a simulated way to do that?
Not really. I mean, you want to measure the impact of a trade, so you kind of got to put a trade on to impact it, to see that impact. One thing you might imagine doing is maybe looking at other people's trades, right? So, certainly in transparent markets like the stock market, every trade is published to data feeds. So you could see like, hey, there was a big buy and then the price went up, right? The problem is you don't know why that person bought, right? Maybe that person bought because they had inside information that there was going to be a takeover. Right, and the price was going to go up because other people figured out about the takeover. Right, it didn't go up because of the mechanical act of buying. Right, so the only way to sort of isolate the mechanical fact of buying is if you buy for no reason. In other words, you buy randomly, or you add a little bit of randomness to your trades. So really, you need your own trading data,
Okay.
and this is and obviously that costs money, right? Because if you put on a random trade, you're sort of spending some money. You're spending transaction costs, right? And so this is sort of very challenging to do, and this is also one of the things that's kind of hardest to do, for example, in academia, because we don't have our own trading data.
Yeah.
Right, and so this you really need to be able to generate random trades and see how the rest of the market reacts.
Okay,
that's my
got
goal.
it. Thank you.
All right. Some trends in terms of so hopefully I've given you a little bit of a perspective of what sort of the current challenges are. I do want to talk about some trends that kind of I see, and I think these are broadly reinforced in the broader use of AI and machine learning and technology and business more broadly. One thing is large scale compute is becoming more and more important. Having access to a lot of computers and basically doing experimentation in silico via simulation, right? So in the kind of trading context, as you work with large data sets, you build predictive models and so on. People do a lot of things like back testing, right? Like let's paper trade over the past 10 years. Let's try lots of different combinations and let's see what works well. So back testing or phrased differently, in silico experimentation. So as you do that, guess what? You need a lot of computers, right? Working with large data sets, specialized hardware and so on. And again, this technology is more broad. So I mentioned AlphaZero earlier. This system that Google stroke DeepMind had built to play Go and chess and so on. They released a paper describing this in 2017, and other researchers have gone back and estimated how much would it cost to replicate what's in that paper. Right. So again, in that paper, they train these systems by having these, Go players, computer Go players, play each other for a long time on many computers and improve. And so you need a lot of computers, and I guess Google has them, right? And if you try to reverse engineer how much money you need to spend to replicate those experiments. So suppose you know exactly what you want to do. You just want to go out and do it, and you want to rent time on Amazon or whatever. Well, it would cost you $25 to $35 million, right? To replicate the a kind of one thing. And you're seeing the same thing, I think, in this space. So a friend in industry told me that one sort of large quantitative hedge fund, each sort of researcher is assigned about 10,000 CPUs in terms of their budget of how much compute they use. And, again, order of magnitude, that's, on the order of hundreds of thousands of dollars, if not, maybe $1 million a year. Again, just spending money on compute. And I think this is kind of mirroring, things, broader in society. So this is a little bit anecdotal, but if you think about Google itself, right? Google is perhaps, one of the largest owners of computational infrastructure around. What do they do with all their computers? Are they, serving ads? Are they, letting you run your Gmail? Are they searching the web? They're doing lots of things. But anecdotally, their number one computational workload is training machine learning models, right? And again, finance is maybe not so different. Over time, we're starting to see more and more an investment in these, having significant compute resources, and I think that's a broader. There's a broader theme of like many other technology-oriented industries. There's increasing returns to scale. Right. So again, if you need a large technical compute infrastructure, that entails a big fixed cost. If you need to exceed transaction costs to profitably trade, that entails developing many different predictive models and adding them up, because your incremental predictions are more and more valuable once you've already exceeded your transaction costs. So all of these mean that large players who are investing a lot have the potential to see increasing returns to scale. So my view is we're going to start to see consolidation, and we're going to start to see larger firms, fewer larger firms, players like Renaissance and Citadel and so on, dominate versus smaller firms. And there's going to be consolidation, much in the way as in a lot of the rest of the tech world over time, due to these kinds of increasing returns to scale. We've seen consolidation and large individual players emerge. So I'll just stop on that note. I'm happy to take any questions. Yes, Anthony. Go ahead. You can unmute yourself.
I apologize if I'm asking too. I have two questions. The first, I think, is easy. Is that your COVID beard, or did you have it before March?
I always had a beard, but it's a little bit longer. But this is definitely my COVID hair. So
okay, my COVID beard. The other is quantitative trading at this level uses massive amounts of intellectual computing and more tangible resources. What value does it create for society? And beyond the investors in a particular fund, and is that value worth these massive costs invested in it?
So I think that's a good question. I mean, obviously, it creates value for the investors and the employees and so on. I think there's an argument that is made that it makes markets more efficient in the sense that prices more accurately reflect information. I mean, I sort of argued that markets are almost efficient. And the reason that is because there's people out there actively, exploiting it. And to some extent right now, it's largely quantitative investors, certainly at shorter horizons. And to the extent that markets are more efficient, that the prices of stocks more accurately reflect all the information, perhaps capital is being allocated more efficiently, right? And because lots of people use these stock prices as signals to coordinate and investment activity and so on. So I think that's an argument that people will be made. Personally, I'm not sure. I mean, again, I don't think, again, we're talking about inefficiencies over timescales, which are short, which are sort of less than a month. So I'm not sure how important that is to the overall economy, but certainly prices are more inefficient, markets are more liquid. I think those are the positive aspects. Again, that's one argument. My view is probably I'm not sure it has tremendous benefits to society, but I think it's largely harmless, right? And I would contrast that to maybe other kinds of use of technology, which we do see in the real world. Things like social media and so on, which people perceive them as maybe adding a utility, but not they may actually be harmful for society. So here, I think it's a bit, it's probably some limited aspect in terms of having more accurate prices, in terms of having more liquid markets. But I think you make a good point to the extent that people are drawn from other types of scientific fields in order to work in quantitative finance. Maybe that's not the best allocation of resources from a societal level.
Mm. Well, maybe you have intellectual advancement and discoveries that ultimately get applied to other fields.
That's true.
Too.
Flip side is people in this industry are extremely secretive. So if a lot of times if you make advancements, you don't. There's no culture of propagating them because it's not in your interest. But one can hope.
Thank you.
Any other questions? Oh, I see a question in the chat. Do you know any organizations that have been particularly successful at using reinforcement learning in trading and are starting to invest significant resources into RL? So, again, knowing what any particular firm is doing is extremely hard because, as I mentioned, the firms are very secretive. On the side where you do see there's more visibility is on the side of banks. So a lot of banks will do trade execution for their clients using algorithms and so on, and there you are seeing RL. So I mean, for example, JP Morgan, a year ago had a paper on using RL for optimized fusion. I'm 100% sure people are using reinforcement learning, right? But unfortunately, it's sort of not public information, so I can't quite name names. Question from Justin.
A lot of this, I think what Anthony was referring to is it seems like there's a lot of capacity that normal people don't have to make such machine learning decisions and training. So how does this impact just everyday people like me who, I don't have the machine learning background, I don't have the tools, I don't have the access to all this data. Do we just kind of trust our brokerage to handle all this? And
don't do it. Invest in index funds. This is what I mean. I think I think maybe one message is that you're competing against people who have a lot of money and are very sophisticated,
right, and
have a lot of computers and so on. So it would be very difficult, I think, for an individual. Now that said, I think there's situations where for something like Renaissance, they probably pull $3 or $4 billion a year out of the market every year, and for them, if you can do something and make $1 million a year, it's not going to move the needle. So I think there's lower capacity spaces where these other people don't compete. But I think you should invest in index funds. You should not do this because the professionals are very sophisticated.
Right. Okay. Yeah. Thanks for that advice.
Question from Anthony also, do I think AI has made markets more efficient or less? Definitely made them more efficient. I mean, more sophisticated methodologies, I think, there's a clear trend over time where transaction costs have gone down, and transaction costs going down means that the markets are more efficient because these anomalies are disappearing. So I think that effect has been positive.
Hi, I also have a question.
Sure.
So first, thank you very much for holding this talk. It's really, really interesting. If you're somebody who has a Columbia MBA, but not like advanced, like a PhD or anything in this kind of topic, but you're interested in this kind of work, how do you get involved into it professionally?
How do you, I'm sorry, I didn't hear the last part.
How do you get into this line of work professionally? If you don't, let's say, have a PhD or specialized like advanced degree in this subject, you just have like a Columbia MBA, but you're, let's say, very quantitatively like oriented, and you're potentially going to be able to get good at it if you get training.
Good. So I think you have to have an edge of some kind. I think if your background is an MBA, your edge is probably not going to be like the most sophisticated, mathematical methodology, right? But that said, I think with an MBA type background, people oftentimes have a much better structural understanding of what's going on. And so on the one hand, maybe you have the mathematician, PhD, data scientists at a place like Renaissance. They view the world as a whole series of numbers, right? I think, someone who's maybe more of an MBA background can maybe dive into the details of, let's say, a particular segment of the world. Like, just to make something up, let's say you really get into oil and how does oil work and how is it traded and where are the pipelines and this and that. You can have a lot of that kind of knowledge and impose quantitative and data type of stuff. And this is sometimes called quantamental, right? Like having a really good fundamental understanding of some area of investable assets, and trying to overlay simpler quantitative models. And there, your edge would not be that you're processing abstract streams of numbers better than Renaissance, because they're really hard to compete with. But your edge would be that they're simply not going to bother sort of diving into the details of some particular industry segment, like let's say oil trading, right? And there, I think if you really dive into the details, you may understand structurally how things work. You may understand what data is relevant and identify data that those other people haven't, and so on. And there, one could particularly one could have an edge. So I think overlaying a better fundamental understanding can give you an edge. But I think it would be it's very difficult to compete. Just at the level of out-quanting some of these very sophisticated firms.
Thank you.
Okay, maybe one last question I see in the chat. Can I elaborate on factor investing, which I mentioned earlier in the talk? So the idea of factor investing, so the idea of active trading, which I've been talking about, is basically buying or selling because you have a view that over some shorter horizon of time, the price is going to go up or down, and you want to position yourself for that. Factor investing is a type of more passive investing, where basically you're going to try to hold an asset for a very long period of time, not because, let's say, you have a view that it's going to go up or down, or so on tomorrow, but simply because you think you're going to earn a risk premium for holding it a longer period of time. Like, and the best example of this is equities. Right? Why do we, why would someone buy, invest in the S&P 500? Well, you do something like that, not because you think the stock market is going to go up tomorrow, because who knows? But you think over long enough time horizons, you think it's going to go up, right? Because over the past 100 years, it's sort of gone up, right? So you can view that as a prediction, but it's a prediction over such a long time horizon, not any particular day or week or month, but really a prediction over years or decades even, right? And so the strategies end up being passive. So equities are one thing, but there might be other types of factors that you invest in, commodities or these things called style factors or so on. The reason why I didn't sort of speak about them is I think number one, they're really less quantitative than you think. Sort of the you don't need sophisticated models to sort of observe that stocks have gone up on average over the past century. You don't need neural networks to sort of do that. You just need to grab something in Excel. So I think the quantitative methods apply there. Also, and this is my personal view and maybe somewhat controversial, I think there's kind of religious aspects to factor investing, right? So why do we think stocks are going to go up in, let's say, over the next 10 years, right? If you do any kind of detailed statistical test, it's really hard to say, right? I mean, you're not saying stocks are going to go up because you have data and you can sort of quantitatively test that and so on. It's more like, well, they've kind of gone up over time, and I have faith in the global capitalist system and the U.S. government, so on and so forth. And I think a lot of factor investing is sort of like that. People sort of identify these factors, and there might be some quantitative aspects, but it's minor, and it's very difficult to sort of statistically assess, is it a real factor or not? And you have to have a point of view. And I view that as more discretionary. and less less really data driven and quantitative. And I mean, if you want to think about it again, you know, factor investing, you're sort of making these bets that you might hold for years, and that's really the realm where statistics and you know so on, at least in financial markets, just doesn't work. Right? Statistics are just not going to tell you what the stock market is going to be doing 5 years from now. Nobody knows, right? You have to have some other you know belief or thesis that's driving that. And my view is that a lot of factor investing is like that. It's less quantitative and more thesis driven at some meta level. Okay, one other question. Questions are coming in. Can use of momentum in a model to trigger a trade lead to vicious cycles of sale in other funds that use computer rely on computer funds? Yeah. So so that's a possibility. That's something that's not well understood. The idea being, if your prediction is that let's say momentum would say that if a stock is going up, it's going to continue to go up. So if you think it's going to continue to go up, so you buy, and your act of buying, if you're in large enough size, may create a self-fulfilling a prediction, or may cause other people to buy, not because it was going to go up on its own, but as a sort of an endogenous phenomena. So that is possible. People call that momentum ignition. But it's you know, it's something that's sort of theoretically possible, but I don't know if it's been proven. Okay, so maybe I'll stop here. I hope this was interesting for everyone, and thank you for your time.
Well, thank you, Professor Moallemi, and thank you to everybody from San Diego, Orange County, LA, and the Bay Area alumni clubs for joining in and having an enjoyable time with us today. Alexandra, do you have anything to add?
Nope. Thank you.
Bye. Thank you,
Bye,
Professor
everyone.
Moallemi. It's great.
My pleasure.